Get the full global macro and markets picture with Capital Economics' all-access packages. CE Essential gives you full access to all of our award-winning written analysis, all of our online briefings, and a host of critical data tools. And for deeper engagement with our economist team, our proprietary data, and seamless integration of that data into your workflow, CE Advance is our most complete solution. Go to capitaleconomics.com today to learn more about CE Essential and CE Advance.
It's Friday, 21st of November, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, Saudi Arabia in a fracturing global economy, and is the AI markets bubble bursting? But first, Neil's out this week. I'm happily joined, though, by Ruth Gregory, our Deputy Chief UK Economist. Hi, Ruth.
Hi, David.
We are just a few days from the UK's autumn budget. Now, this has got to be one of the most tumultuous, one of the weirdest build-ups to a fiscal event. For listeners who haven't been following the day-to-day, I just need to list a few moments that have led up to this. So there was an announcement at the start of September that this budget would be announced at the end of November. So the final week of November, just before the sort of the Christmas run-up. There was a November 4th, what was called a scene setter press conference, in which the Chancellor Rachel Reeves strongly hints that income taxes are going to rise, despite a promise at election time last year that this wouldn't happen. And then there was reporting that followed that the budget plan has basically been ripped up, that there won't actually be an income tax rise. And in the meantime, in the backdrop, it seems almost every day there's a new idea, a kite being flown around ideas for raising revenues in the press. Ruth, let me ask you, you worked at the Office for Budget Responsibility. That's the UK's fiscal watchdog that's overseeing the budget. I have to ask you, have you ever seen anything like this?
I don't think we have ever seen anything quite like this. The long build-up to the budget, as you say, has meant that there's been a huge amount of kite flying with all manner of policies floated to see how they'll land with the public and the media. As you said, the Chancellor gave that unusual pre-budget speech on the 4th of November, paving the way for a possible manifesto-breaking income tax hike, only for reports to emerge, possibly due to Starmer's weakness, that those plans had been ditched. I think the problem with all of this is that while floating potential tax changes to the media might help to manage expectations or make the final budget appear a bit more sensible, it does increase uncertainty, it hits sentiment, and the risk is that households and firms make what might prove to be inefficient financial choices based on tax changes that don't actually happen. And we're already seeing some of the effects of this in the economic data. Most obviously, the prospect of tax rises, potentially on property, appears to be weighing on house prices at the top end of the market and for the most expensive regions. So if you look at, for example, house prices in prime central London, they have fallen by 14% actually in the 2 months to August. Now, if you look at the past, the run-up to the budget hasn't always been this way. And if you go back far enough until the mid-1990s, chancellors did observe that period of news blackout or budget purdah very seriously. And that was rigidly adhered to. So much so, I think the Chancellor, Hugh Dalton, back in 1947, leaked his budget to the press before delivering his speech, and he did resign. So back then, perhaps the best that the media could expect was a picture of the Chancellor walking their dog shortly before the announcement. Whereas today, some commentators have likened the Chancellor's possible patchwork of tax hikes to a dog's breakfast. And I think given the messy menu of tax hikes on offer, we'd probably be inclined to agree.
So the original sin was perhaps scheduling it so late in the year, allowing for weeks of speculation, allowing for weeks of leaks to the press, allowing for uncertainty to bleed into households and businesses. But it sounds like just the whole process of announcing a budget needs to be looked at.
Well, I think there's certainly advantages to having a decent lead up to the budget. It's allowed the Chancellor to get advice on various aspects of her policy. I think the problem this time has been that, as you say, the lead up has been longer than usual. And on top of that, we have seen perhaps more kite flying and floating of those tax changes to the media. And that just has created that uncertainty, the potential to hit sentiment. And you're already seeing some of these effects filtering out into the economic data.
Rachel Reeves last year said, quote unquote, "I want to be the most pro-growth treasury in our country's history." Is this going to be a pro-growth budget? I mean, what are we expecting at this stage? Given all of the speculation, all of this kite flying, where are we as of today, 21st of November?
Yeah, I think the Chancellor's first job really is to raise enough revenue to convince the markets of her fiscal discipline. And we know that the government's U-turns on spending cuts earlier this year, increases in borrowing costs and forecast downgrades will mean that the Chancellor, before any budget policies, is on course to breach her main fiscal rules. So the Chancellor needs to reassure investors that she'll put the public finances on a stronger footing by restoring or rebuilding her buffer against her fiscal rule if she wants to prevent the financial markets from charging the government a higher interest rate on its borrowing. Her second job is to satisfy backbench Labour MPs. So if Labour MPs were to vote down the budget policies in Parliament, it could effectively turn into a no confidence vote in the government. And her third and final job, I think, is to shore up the public finances in the least damaging way for economic growth, as you mentioned, that pro-growth aspiration of the government, and to ensure that the policies reduce inflation rather than exacerbate near-term inflation. Now, the reports that the Chancellor has backed away from a rise in income tax in favour of a shopping list of smaller taxes suggest that perhaps this will be a budget more for Labour MPs rather than one for the financial markets or the economy. In other words, the Chancellor does appear to be putting the political optics ahead of reassuring the financial markets or mitigating any damaging effect to growth. And we do think that the Chancellor will probably raise taxes by around 38 billion, which is almost as big as the 41.5 billion increase in taxes in the Chancellor's budget a year ago.
What's the macroeconomic backdrop against which this budget is being released? I know we had loads of UK data out this week. What are they saying about where the economy is?
Yeah, so I think the retail sales and the public finances figures which were released today, they're too late to have a direct effect on the budget decisions, but I do think they present a distinctly unfavourable backdrop to next week's budget, with the government borrowing more than expected in October and retail sales falling sharply at the start of the so-called golden quarter. I suppose the one silver lining from the recent run of soft economic data is that, and what is looking like a very big tax-raising budget, is that it's becoming a bit more likely that the Bank of England will reduce interest rates further than most expect. The other big news this week was the fall in inflation from 3.8% in September to 3.6% in October. Now, that was the second softish inflation release in a row. And it suggests that September's weakness was a genuine softening in underlying price pressures, which has been built on a little bit in October. And if you take that together with the recent rise in the unemployment rate to 5%, the easing in wage growth, the softness of GDP growth in Q3 and what's set to be a big tax-raising budget, I think this all suggests that the disinflationary forces are building. And I think this could well prompt the Governor of the Bank of England to put on a red suit and a white beard and cut interest rates from 4% now to 3.75% on the 18th of December.
But the basic message there, I mean, £38 billion in measures to raise taxes doesn't sound very pro-growth. My question is, what will all of this do to the British economy? But is there a difference in terms of raising income taxes versus this smorgasbord of measures that it sounds like we're going to be getting?
Yes, so based on our estimates, we think the budget policies might reduce our GDP forecast by 0.3% in total, with around 0.2% of that hit occurring in 2026. Now, that wouldn't be enough to trigger a recession, but it would mean that instead of the economy growing by around 1.2% next year, as we expect, it might grow by possibly around 1%. That said, I think the risk is that the hit to GDP will be a bit bigger than this. And I think there are possibly around three reasons why a smorgasbord approach, by which we mean a whole host of increases in smaller taxes rather than hikes in a few big taxes, could prove a bit more damaging for growth. The first is that smaller taxes need to rise further than bigger taxes to generate the same amount of cash. So there's a greater chance of adverse effects on the incentives to work and to invest and to save. The second is that smaller tax rises can be concentrated in areas that are a bit more damaging for growth. So, for example, if the Chancellor were to change salary sacrifice pension scheme thresholds, that could exacerbate the UK's savings deficiency. And the third is that this approach, this shopping list of smaller taxes, might be viewed as less credible by investors because smaller taxes generate more uncertain revenue for the Chancellor, which could prompt the financial markets to charge the government a higher interest rate on its borrowing and mean that government borrowing rises even further. And if there's anything to take away from the sell-off in the gilt market in response to the reported income tax U-turn last week, it's just how sensitive investors are to the UK's weak fiscal position. So I think this does raise the risk that the hit to GDP could be a bit bigger than otherwise, and that in turn could increase the chances that this tax-raising budget won't be the last.
Is there any good news here? Is there an optimistic note we can end on?
Yes, I suppose if there's any comfort to be had, it's that the rise in taxes that we expect of 38 billion will probably lower inflation and lower interest rates. So I think we are becoming a little bit more confident in our view that the bank will reduce interest rates further than most expect, from 4% now, perhaps to 3% next year, rather than to 3.5% as investors expect.
Okay, and what's the scope for a surprise next week that Rachel Reeves stands up in the House of Commons and says something that just blows everyone's mind?
I think our expectation is that the Chancellor will raise taxes by about 38 billion in the budget, and that will reduce GDP growth, perhaps by around 0.2% next year, weigh on inflation and contribute to more interest rate cuts. But there is a risk that the markets do give the budget a thumbs down. For example, if the fiscal tightening is a bit smaller than anticipated, or if there's a mess of smaller and backloaded tax cuts. There's a risk too that the budget policies could directly increase inflation in the near term rather than lower it as we expect. And as I already mentioned, I think the risks are tilted towards a bigger hit to GDP than we currently expect. So I think the stakes are very high, and the chances of an adverse gilt market reaction do remain high next Wednesday.
That was Ruth Gregory on the UK budget that's coming this Wednesday. Look out for our written analysis and a drop-in. That's one of our short-form online briefings just after Chancellor Rachel Reeves' statement that day. If your macro provider is making you wait a day or two for a briefing on what this budget means for your strategy, well, then you're missing out. If you want to speak to our economists on the day of the statement, then get in touch and we can set you up with access. Contact us at sales@capitaleconomics.com. Now, it's been a tough few weeks for stock markets amid creeping worries about this AI story that's been driving equities prices to record highs. Nvidia, which is the chip leader and a bellwether for the AI industry, reported earnings this week that comfortably beat analyst expectations. But that only provided temporary relief to the markets. Stock prices rose briefly on Thursday in the wake of the Nvidia announcement before plunging back again. We still think the S&P 500 will rise higher into 2026, but we also can't ignore the fact that as the market has risen, so have the risks to the rally. To find out what's been going on, I had a quick word with Jonas Goltermann, our Deputy Chief Markets Economist, ahead of the open on Friday, and I started by asking whether the recent weakness marks the beginning of the end.
It could be. That's the honest answer. Our base case has been that the air boom has further to run and that we'll hit 8,000 on the S&P 500 next year. That's based on the AI build-out continuing at pace, earnings continuing to grow rapidly, and valuations being able to stretch a bit further, if you will. Our forecasts throughout, since we made this call almost 2.5 years ago now, has been the idea that the forward PE ratio for the S&P 500 could get all the way to 25, which is what it hit in the peak back in early 2000. That compares to about 23 before the recent sell-off. But of course, that's a sort of rule of thumb, if you will, a best guess. There's no hard and fast rule that says we have to get all the way there before the bubble bursts, or indeed that if we do get there, that we're going to have to stop there and the bubble has to burst right then. It could go even further. And the main reason that we have remained bullish is that the AI build-out, it still looks to be in fairly early stages in terms of the CapEx cycle, in terms of adoption across the wider economy, just in terms of both technology developing and people working out how to use it. And so far, big tech earnings have kept rising very rapidly. And this earnings season has actually been a very strong one. You saw Nvidia earlier this week, they basically hit it out of the park. So it's not that the fundamentals have changed. Sentiment has shifted over recent weeks. But set against that idea that the reasons to be bullish, there's no question that the stock market has run well ahead of the actual macroeconomic impact of AI, well ahead of the actual roll-up in the economy, and that there is an awful lot of optimism has been priced in. So in that sense, the bubble could certainly burst before we hit peak AI build-out. I think that is likely to happen. Doesn't mean that that's going to happen right now.
How would we know that this is the end of the rally versus a correction? We have had occasional corrections, and then stocks have risen back up to even higher levels. So how do we know that this time was different?
I'm not sure we would at this stage if say no one rings a bell at the top. Now, having said that, sometimes they do quite clearly ring a bell, and sometimes stock market peaks and sell-offs, they happen for very obvious reasons. I'm thinking of the tariff sell-off earlier this year, or things like COVID or the GFC. The reasons right there in the open, you don't know at the start how bad it's going to get. But the fact that there's bad news and the stock market has to correct, it's plain for all to see. Even something like early 2022, which turned into a bear market, the most recent one, there was a number of factors that suggested it was going to be a tough year for equities. Even if the S&P 500 fell 25%, peak to trough, that was a result of an accumulation of events and bad news that weren't obvious at the start of the year. You don't know how bad it's going to get, but you could see at that point that things weren't looking great. And then you have other instances like 1987 or 1929, where there's just a massive shift in one day, not quite out of the blue necessarily, but just in a sort of extraordinary shift in sentiment, and market mechanics go into a vicious circle. And clearly what we've seen so far isn't on that scale. And I would say this also doesn't fall in the first category because there isn't any obvious bad news. As you mentioned, Nvidia earnings earlier this week, they were really strong. Earnings season for tech companies has been generally pretty strong. That there isn't any obvious shift in the fundamentals. There's a shift in sentiment. There's a shift in belief about how far this build out can go in terms of maybe the financing, maybe some of the bottlenecks in the AI build out in terms of energy supply and construction and so on, things on that front. And just the idea that maybe it's not going to deliver all. Like I said earlier, there's an awful lot of good news priced in. Maybe there's just been a shift in belief about how profitable this whole thing is actually going to be.
Isn't that an echo of 2000, March 2000, where there was just a loss of confidence as the market rose ever higher? There was a loss of confidence in that case whether the companies that were rising were ever going to make a profit.
Yeah, that's the obvious analogy, is the dot-com bubble, because there's a lot of similarities between what's happened over the past 2-3 years and what was happening back then. And that, as you say, that's the case where there wasn't really an obvious trigger at the time beyond maybe the fact that valuations had gone very stretched and in some cases clearly unsustainable. But it took a while before it was clear that bubble was going into reverse. I think that's a clear case of no one ringing the bell at the top. And people still debate just what it was that triggered the collapse. Was it Fed hikes? Was it antitrust cases? Was it just the crazy valuations and things were falling under their own weight? Or maybe just you run out of the next fool to sell it all onto. So that I think is, as you say, that's the worry now, that we're seeing a similar dynamic take hold. And look, we focus on the fundamentals and they still look good, but sentiment around this whole AI build out, it's certainly taken a turn for the worse. And that could potentially lead to this kind of self-reinforcing downward loop. But I think at the end of the day, if these companies keep growing earnings as quickly as they have, then the share prices are going to hold up and probably rise further.
It's worth repeating, our central forecast is that the S&P 500 will keep rising in 2026, but also, at one point, this bubble, or whatever we want to call it, is going to burst. Stocks fell nearly 50% after the dot-com bubble burst. They fell nearly 90% in the years after the Wall Street crash in 1929. So when this bubble bursts, how much downside would we be talking about?
We think about what would it look like when this all ends. It probably would look a bit like this, which is the worrying part. Tech led on the way up, and it would probably lead on the way down. Again, the dot-com bubble is probably the best guide that we have. There are plenty of differences in history typically rhymes. It doesn't repeat line for line, but there are enough similarities that it's worth exploring in detail. We've actually just put out a note that does exactly that. So I would encourage everyone to read that note from John Higgins that was out earlier today. So the short version is that when a big bubble bursts, it typically leads to really quite big falls. So the dot-com bubble saw a roughly 50% drop in the S&P 500, and the NASDAQ tech index fell by around 80%. And tech is actually a bigger share of the S&P 500 now than it was back then, so the gap between those two numbers wouldn't be as large this time around. Now, obviously, that's a pretty extreme scenario, and the dot-com bubble bursting wasn't the only thing that was going wrong in the early 2000s. There was the recession that followed, there was 9/11, and there was those accounting scandals around Enron and WorldCom that really hit sentiment and valuations quite a bit well after the bubble had actually burst. So the whole thing took 2.5 years from start to finish, which is one of the longest bear markets on record. And like I said, that's extreme. And one difference between now and then is that the companies at the heart of this boom are very well established, more so than was the case 25 years ago. And they have been very profitable and growing profits very rapidly for quite a long time now. The AI boom, in some sense, is only the latest extension of what was already a long period of tech outperformance. So these firms, they have something to fall back on in a sense if the AI thing doesn't pan out quite as well as everyone hopes. And look, one way to quantify what might happen is to look what's been happening to the S&P 500 equal weighted index. So if you assign the same weight to all 500 shares, you get the performance of the average stock, if you will. And if the overall index had done as well as the average stock, then we'd be around 5,000 now instead of 6,500, which is a testament to just how much of the gains has been concentrated in a handful of very large firms. And that gives you a sense of, or maybe roughly how much of a fall you could get if this were to all unwind starting from now. I should say that's a sort of a bear case scenario. It's much worse than what our base case is, which is, as you said, we're looking for 8,000 by the end of 2026 and a correction down to something around 7,000 by the end of 2027, and probably a bigger fall than that in peak to trough terms. So that's our base case. And obviously the risks that it all comes apart sooner have increased. It could be that we're seeing the start of that now, but we do think that this ongoing correction is going to work itself out and that we'll see a new high later this year or into 2026.
Jonas Goltermann there on the AI rally, the beginning of the end or just a stumble on the way further up the mountain? We always joke that he's only ever on the podcast when markets are falling out of bed, so if you don't hear from Jonas for a while, then you'll know that this was just a correction. Nonetheless, there are a few pieces of analysis that I'll add to the podcast notes, including one on valuations, but also that note from Chief Markets Economist John Higgins about what the shift from AI boom to AI bust could look like. Finally this week, I said that Neil Shearing, our group chief economist, was away. He's been in the Gulf over the past few days, talking to clients about, among other things, our view that the global economy is fracturing into US and China-led economic blocs. Neil usually begins our podcast each week talking about the big issues in global macro, but in a stunning revision of the established format, he's going to close out the podcast this week. I spoke to him a few days ago when he was between Kuwait and Bahrain. And we spoke just after Saudi Arabia's Crown Prince Mohammed bin Salman had met with Donald Trump at the White House. Here's my conversation with Neil now. It's Wednesday, the 19th of November, and this is your Capital Echoes Weekly Briefing. But I won't. You've been in the Gulf for the past few days, talking to clients, getting a sense of the macro picture, explaining the global macro picture to them. The big diplomatic news this week has been that meeting at the White House between Donald Trump and Mohammed bin Salman, Crown Prince. To kick us off, just give us a sense of how that meeting looks from the perspective of the Gulf.
Well, needless to say, it's dominated the news agenda here. And it's also the case that it's dominated client discussions as well. Lots of interest in the US and the Fed and inflation and the dollar and global economic fracturing in the book. But of course, that's been given all the more focus for this meeting and seemingly an attempt to reset or rather improve perhaps relations between Riyadh and Washington. So it has dominated the news cycle here, as you might expect, and obviously has big ramifications for how we think about the geopolitical map.
Yeah, they put on quite a show in Washington, didn't they? Fun fact, there were 6 F-35s doing a flyover of the White House for MBS. The last time there was a flyover the White House, 2019, Polish President Duda, he only got 2 F-35s. So if you're measuring this by the number of F-35s in the air,
It's three times better.
3 times better. There you go.
Even I can do that maths.
It is striking, though, and I think you've made this point before about global economic fracturing and how it would have happened with or without Trump. But here we are seeing a concerted effort to bring Saudi Arabia back into the fold, to bring it back towards the US orbit and away from China, crucially. And it's interesting, isn't it, how the contours of fracturing, certainly in this case, have been very much dependent on the whims of Donald Trump. And that marks a shift in US policy from the Biden administration. It certainly didn't happen in the Biden administration. Arguably, it wouldn't have happened under a Harris presidency either.
No, I agree. I think if you take a step back and look at what's happened this week, a lot of it has been driven by a personal relationship between President Trump and MBS. So I think it's difficult to believe that this would have happened under any other presidency. But as you say, it's a reminder that the exact shape of this global economic fracturing is yet to be determined, and that the personalities involved will determine the exact form of fracturing that we get. Now, I think with all of that being said, I think it's important not to overstate exactly what has happened, what has been agreed this week. It's striking that, yes, we've been all focused on F-35s and not just the flyovers, but the amount that will be supplied by the US to Saudi. But they've stopped short of a full defense security pact, which might be telling. And maybe that's because of concerns on Capitol Hill and in parts of Washington that in doing so, it might expose some advanced US technology, military technology and hardware to China, which obviously has growing defense and security ties with Saudi. So clearly a big shift in relations between Washington and Riyadh, clearly a concerted effort to get Riyadh back into the US fold. And I think if we were to redraw our fracturing map again today, then at the very least we'd have Saudi unaligned and possibly leaning towards the US. But stop short of that full defense security pact. And I think that reflects still these concerns in parts of the establishment in Washington about Saudi's ties with China.
I was talking to David Oxley, our chief commodities economist, earlier, and he was talking about how striking it was, that word keeps coming up, how striking it was that how little a role that oil played in this bilateral conversation, in this meeting in Washington, and instead how much it was about technology, military technology, the hardware of the F-35, but also AI, or Saudi Arabia's efforts, along with the rest of the Gulf, to be at the forefront of this technological push. What does that tell us about the contours of the framework for thinking through how the global economy is developing?
Yes, just on that area of AI, it's striking actually that, yes, there might be some concerns around defense and security in parts of the establishment in Washington about Saudi's ties to China. The US and Saudi are far more aligned in the area of AI. Senior players in AI in the Saudi leadership have explicitly stated that they won't be using Chinese chips in AI, and are hoping to secure the most advanced chips from Nvidia. So it potentially a bit more alignment between Saudi and the US over AI. But back to your point about energy, this is a really interesting one, and I think that it gets to the heart of how economic relationships have shifted and changed over the past couple of decades. So if you wind the clock back to the end of the Cold War, 1990, about 1/4 of Saudi's exports went to the US, essentially oil. Today, that number's below 5%. And in contrast, exports to China from Saudi were negligible in 1990, and now they account for about 15% of all of Saudi's exports. So there's been a complete redrawing of the trade map for Saudi away from the US and towards China. Of course, partly that reflects China's rapid growth and increase in energy dependence over the past 2 decades, but it also, of course, reflects the effects of the shale revolution in the US and the fact that the US has shifted from being a huge net energy importer to being a small net energy exporter. Now, and of course, the world's biggest producer of oil. So these economic relationships are shifting and changing and developing all the time. And that, of course, then feeds back into the changing nature of political relationships between countries, which in turn feeds back into the economic relationships, because obviously that determines, to some extent, investment flows between these countries. Worth noting, too, that Saudis has been in the past been in receipt of BRI investment from China, too.
Yeah, I guess all this coverage this week of this meeting, you can take that too far and neglect the fact that China remains a major player in the region. China is far more, as you hinted at there with those numbers about China's role as a buyer of Saudi oil. China is a big regional player, remains highly engaged in the region. You've made the point before that economies are going to struggle to stay neutral in a fracturing world between these two economic blocks, US-led bloc and China-led bloc. How does this play out in terms of Saudi alignment? We've spoken before about the challenges of Southeast Asian countries in balancing these relationships. Is it a similar story in the Gulf?
Well, I think that the key point I would make in this regard is that there's an allure of neutrality within fracturing. Everyone's trying to be the Switzerland of the fractured world. In other words, trying to straddle both sides, remain neutral. And I don't think that many countries can do that, because I think ultimately it will be the US and China that determine whether or not a country is allowed to remain neutral in this fractured world. And they will make that calculation based on several factors. But I think at the moment, the way the world is shaping up and this fracturing is shaping up, it's technology and national security that seem to be the key dividing lines, the key fault lines of this fracturing. Now, viewed through that lens, if you're the US and you're now a net energy exporter, then you might not be too concerned about Saudi having strong trade relationships with China, because oil is no longer absolutely fundamental to your economy as it was, or fundamental vulnerability, weak link as it was, say, 20 years ago. Instead, you're much more concerned about chips, you're much more concerned about advanced technology, you're much more concerned about data flows, and so on and so forth. So there are very few countries that I think will be able to be truly independent and neutral in this fractured world. But it's possible that one of them is Saudi, as a country that has strong trade relations with China, that the US is frankly not too concerned about at this stage, but has increasingly strong relationships on the defense and security side with the US. And the objective for the US will be to stop that relationship around defense and security bleeding US technology into China, I suspect. And I think that will be the focus over the coming years and decades.
What about financial ties? Because there was a lot of noise last year, actually for a long time there's been a lot of noise about China paying for its oil purchases from Saudi Arabia with renminbi as part of this renminbi internationalization project that Beijing's been pushing for years, providing a counterweight to the dollar, trying to break the dollar's dominance in the global financial system. How much of that is just noise, or is this talk of the rise of a petro-yuan and the demise of the petrodollar, is that a thing?
If I had $1 for every time I've been asked that question in the past week, a petrodollar, then I have a significant chunk of foreign exchange reserves that I could play with. But so it's definitely a question that is on investors' minds in this part of the region. And I guess that makes sense if you think about the kind of news flow and the developments and the push from China to internationalize the renminbi through particularly settlement of trade with partners here in the GCC. However, I think, again, a bit of context and perspective is necessary. If you look at the bilateral trade flows between China and the Gulf, and throw in Russia too, because Russia's a major oil exporter, and so you get this idea of a petro-yuan as a result. So the idea that all of this trade between China and Russia and the Gulf is settled in renminbi or yuan, so you get a petro-yuan. That's still only 2% of total world goods and services trade. So the idea that you get this massive spread in the yuan through the global economy as a result of it being used to settle Chinese imports of oil, I don't really buy, to be honest. I think, yes, it's clear the direction of travel. It's clear that China will push to settle more of its imports of key commodities, and particularly oil, in yuan. But I don't think that fundamentally challenges the dollar. And I certainly don't think that it means that we start to get the oil and other commodities priced in anything other than the dollar in the coming years.
And that all implies that the sort of Gulf pegs to the dollar aren't going anywhere anytime soon.
Exactly. So I think, again, that's another sense in which this part of the world, the GCC, is going to remain inextricably linked to the US. It's partly defense and security, but it's also financial. It's the fact that their currencies are pegged to the dollar, and those pegs at the moment look pretty stable, they look pretty secure, they're backed by large amounts of foreign exchange reserves, and they make sense given the the high degree of exports that is oil, and is obviously denominated in dollars. So again, another key source of linkage between the region and the US.
Neil Shearing on Saudi Arabia and the other Gulf economies in a fracturing global economy. There's a write-up of the meeting between MBS and Trump by James Swanston, our MENA economist, which I'll add to the podcast notes. And look out for our annual revision of our map of global economic fracturing, which will be out at the start of next year. Neil's book, The Fractured Age, has just been named one of the best economics books of the year by Martin Wolf from the Financial Times. The Fractured Age is available wherever you get your books, be they physical, ebooks, or audio. But that's it for this week. We will be back next week with a special podcast all about what was announced in the budget and what it signals about the future of the UK economy and its financial markets. Until then, goodbye.